A recession is an economic downturn characterized by a significant decline in economic activity across a country or region. During a recession, there is a contraction in various indicators of economic health, such as gross domestic product, GDP, employment, consumer spending, business investment, and industrial production. Recessions are a normal part of the business cycle and can be caused by various factors, including changes in economic policies, external shocks, financial crises, or natural disasters. The onset of a recession is often marked by 2 consecutive quarters of negative GDP growth, though it can also be identified through other economic indicators. Recessions can vary in duration and severity, ranging from relatively mild and short-lived to deep and prolonged, as seen in the Great Recession of 2007 to 2009. One of the key drivers of a recession is a decrease in consumer spending. When people become uncertain about the economy's future, they tend to cut back on discretionary purchases, leading to reduced demand for goods and services. This, in turn, impacts businesses, leading to lower revenues and potential job losses. Business investment also tends to decline during recessions. Companies may delay or cancel capital projects and expansions due to decreased consumer demand and uncertainty about the economic outlook. This can further exacerbate the economic slowdown and lead to increased unemployment. A recession often results in financial market volatility. Stock markets may experience significant declines as investors become more risk-averse. Additionally, credit markets may tighten as lenders become cautious about extending loans to individuals and businesses, making it more difficult to access credit. Governments and central banks typically respond to recessions with fiscal and monetary policy measures to stimulate economic activity and support financial stability. Fiscal policy involves government spending increases and tax cuts to boost demand and stimulate the economy. Monetary policy, on the other hand, is controlled by the central bank and may involve lowering interest rates to encourage borrowing and investment or implementing quantitative easing to inject money into the financial system. Despite these measures, the recovery from a recession can be gradual and uneven. The duration and strength of the recovery depend on various factors, including the severity of the initial economic shock, the effectiveness of government policies, and the resilience of the private sector. Recessions also have social and human impacts. Unemployment and financial stress can lead to hardships for individuals and families, affecting mental health and overall well-being. Moreover, the distributional effects of a recession can be unequal, with vulnerable populations often experiencing more significant challenges. In conclusion, a recession is a period of economic decline characterized by reduced economic activity, declining GDP, lower consumer spending, reduced business investment, and increased unemployment. It is a normal part of the economic cycle and can be triggered by various factors. Governments and central banks respond with fiscal and monetary measures to support the economy and facilitate recovery. Despite these efforts, recessions can have far-reaching consequences on individuals, businesses, and society as a whole.